Hi, if you've been feeling a little uneasy looking at the markets over the last few weeks, trust me, you're not alone. Markets have been volatile. Global geopolitics, interest rate uncertainty, currency movements, there's a lot of noise out there. But let me start with a simple truth. Market volatility is normal. It always has been. I've been tracking markets since around 1992, starting with the Harshad Mehta phase. And compared to those days, Indian markets today are far more mature and resilient. Yes, we are impacted by global events, but we also have strong domestic participation, healthier companies, and a growing economy. That makes a big difference. Volatility feels uncomfortable, but it is not unusual. In fact, it's the price we pay for long term equity returns. One important reminder, especially during times like these: equity investing is goal based, not event based. We don't invest based on today's headlines or tomorrow's predictions. We invest based on your goals and your time horizon. Any money you need in the next 2 to 3 years should not be in equity anyway. That belongs in debt or safer options. But if your goals are long term, retirement, children's education, long term wealth, then market corrections are part of the journey, not a reason to panic. Let's also be realistic. When markets fall, equity portfolios will fall. That's normal. Expecting otherwise is unrealistic. There is no such thing as no risk but great returns. Anyone promising that is selling fiction, not finance. And remember, portfolios should be judged as a whole, not fund by fund. Asset allocation matters far more than individual short term performance. When we say stay invested, it also means continue investing when markets are down. This is where SIPs actually work best. Market corrections allow you to accumulate more units at lower prices. Those who stayed invested during 2008 and 2020 understand this very well today. Wealth is built by discipline during bad times, not excitement during good times. Before worrying about returns, please make sure three basics are firmly in place: an emergency fund covering at least 6 months of expenses, adequate term insurance, and proper health insurance. These are non negotiable. They protect your investments and your peace of mind. In our own practice, we see this clearly. Families who have stayed invested longer are doing significantly better than those who are new or impatient. Compounding works with time, not with impatience. If you have concerns or doubts, please reach out. That's what I am here for. But let's not allow short term noise to derail long term plans. Stay disciplined, stay invested, stay focused on your goals.